Hello everyone, I'm Kate Hill and welcome to the Adviseable Advantage Property News Update. Before we get started, please don't forget to subscribe to our YouTube channel and hit that notification bell so that you don't miss out on further news updates on our suburb analysis reports and our free webinars. Don't forget that we at Adviseable are out there every day, 24/7, looking at property, analysing property, buying property. We are at the coalface of what is really going on out there. We are here to help you if you have any questions at all or you need help buying property. As an overview, in today's programme, I will cover off on some thoughts on the activity of first homeowners in the market and the COVID bargain myth, how regional property markets are thriving, national house price news, the economic cliff, and you're going to see an advisable area analysis report. You can jump to each particular segment that you're interested in if you don't want to watch the whole programme. First, a note to everyone out there, and I know I bang on about this all the time, but it's imperative that you listen to this and be aware. And it doesn't just apply to the property market. For many of us, there has never been a time where the media has so many sensational stories to write. The pandemic has presented such an array of spectacular impacts that there has been really no need for embellishments by the media. But the natural impulse for journalists is towards sensationalism and hyperbole, dramatic headlines. Prices don't rise anymore, they soar, they surge, skyrocket, explode. Prices don't decline, they plummet, plunge, nosedive, crash. They are all fighting for your attention in this 24-hour news environment, and they need content. It's all about reeling you in and keeping you engaged for as long as possible to improve their ratings. It's all about revenue at the end of the day, of course. But this comes at the expense of actual facts and truth. They seem to be secondary, and things like a company's press release are reported as though it was well-researched fact. The whole of the media has taken a highly negative and sensationalist approach to reporting all kinds of news, but in particular the housing market. The importance of this is not so much the annoying nature of relentless negative news media, but the reality that it all creates to create a big amount of misinformation, and this misinformation causes people and you to make bad choices and miss out on opportunities and ultimately to lose money. If you must read the newspaper, then please do so with caution and read everything with this in mind. Get your advice and your news from a reputable and well-researched, qualified expert source. Okay, and with that little rant over, let's get on with it. There has almost never been a better time for first home buyers to get into the real estate market, with a number of federal and state government incentives offering an unprecedented financial leg up. In some states, first home buyers can secure more than $50,000 in government grants to help them into their first property. Now, you couple this with interest rates at historical lows and the federal government's first home loan deposit scheme, which means that buyers need to save only a 5% deposit to get into the market. In addition to grants, most states offer no stamp duty for homes under a certain value, or at least stamp duty concessions, which make buying even cheaper for those in the market for the first time. For those buyers who have steady and secure employment at the moment, the financial incentives for entering the market as a first home buyer will most likely never be as good again. First home buyers now comprise one of the biggest segment of buyers in the market, and this trend is keeping prices buoyant in certain areas. This definitely has consequences also for investors looking to buy in growth areas, as there really aren't those bargains out there that so many people think are out there. I touched on this next topic very briefly last week when I reported that Australia's regional property markets are thriving. Well, indeed they are. More and more city dwellers are turning their backs on expensive big city living, regional property markets have withstood the economic downturn, which followed the start of the pandemic, extremely well. And they are now on the radar of both investors and homeowners looking for more affordable lifestyles. This trend was already well underway before the pandemic has shown more employers that their staff can work remotely effectively. We could expect that this will become a permanent arrangement for many people. Even once the pandemic passes, saving businesses substantial office space costs and delivering better work-life balance for those employees. So when we consider this, not only do regional towns offer a more relaxed lifestyle than many capital cities, but they offer owner-occupiers and investors much more affordable property. These facts are borne out by CoreLogic figures, which revealed in the June 2020 quarter, at the peak of the virus lockdown, that regional centres throughout Australia experienced better capital growth outcomes than capital city markets. The solid regional results aren't just a pandemic flash in the pan either, with CoreLogic data revealing that regional property values had already been on their way up at the end of 2019 and the beginning of 2020. For owner-occupiers searching for a much more affordable lifestyle, there are ample options within 1 to 2 hours of the state capitals. But buyers also have been active in more distant locations, and there has been good capital growth in a wide range of regional centres in the past 12 months. Strong price rises have occurred in Victoria, Queensland, New South Wales and South Australia. Now, as always, we urge all buyers to focus on locations with diverse economies, growing populations and good transport links. Click this link here and you can listen to me discussing in detail the research that you need to do to make sure that you're buying in a good, solid area with growth prospects. Investment in some regional markets has been volatile in the past, particularly in areas relying on just one main industry. Many investors really came unstuck during the mining downturn a few years ago, when properties in regional mining centres like Moranbah in Queensland and Port Hedland in Western Australia experienced very high vacancies, falling rentals and a very sharp decline in property values. We're warning you that those risks still exist for investors in regional centres which rely mainly on one economy only. You really need to do that research, or have a buyer's agency like us do that for you so that you're mitigating those risks as much as possible. Australian house prices have been very resistant to the negative forces of the pandemic and the economic downturn that created. This is shown by the month-by-month data from CoreLogic here and quoted from the monthly Hotspotting Rider report. This table here shows that overall there has been a very gradual deterioration in prices. Looking at the average national result, house prices were up 0.7% in March, up by a smaller amount in April, down marginally in May and down by a larger amount in June, and then a similar, though slightly better result in July. Looking at these figures at a more local level shows that some locations have been more resilient than others, of course. The latest figures by CoreLogic show that half the property markets managed to produce some growth in their house prices during July. These markets are the 8 capital cities and the 7 state or territory regional markets. Of those markets, 7 produced some level of growth in house prices in July, which is really quite remarkable in the circumstances that we find ourselves at the moment. Those figures also illustrate a point I just made earlier, in that the regional property markets are generally doing better than capital city markets. In July, 5 of the 7 regional jurisdictions produced house price growth compared to 2 of the 8 capital city markets. Of course, I would also like to stress that looking at month-to-month figures in real estate can be highly problematic, erratic, and unreliable as an indicator. We really need to be careful about placing too much emphasis on 1 month's result only. You always need to consider the bigger picture. Many commentators have said that the end of September was the danger zone for the economy. The fears were that with the JobKeeper stimulus previously due to end, and the first wave of mortgage deferrals to cease at this time, it could mark a turning point for the economy towards greater unemployment, forced property sales, and steep property price falls. Now, as most of us will know, it has been announced that both JobKeeper and JobSeeker will be extended beyond September. More stimulus measures have been announced, including pandemic leave in Victoria, so those concerns have been somewhat lessened. However, it does raise the question, will we see the so-called September cliff simply shifted to a later date? Well, economic shifts, like most property price movements, are rarely that neat. Rarely do we see economic shifts or property price movements occur so rapidly. And yet commentators, markets and investors will often react to certain events as if the outcomes are going to be felt immediately. Remember that in the lead up to the 2019 election last year, the uncertainty over the result led many investors to just sit on their hands. And if Labour was going to win, it would have meant the possibility of reform to negative gearing and capital gains tax, which spooked a lot of investors. When the coalition won in a surprise upset, investor sentiment really rallied and the share market surged to an 11-year high. So confidence is rarely rational. Each action has a reaction. And the example of the federal election reveals how irrational consumer and investor confidence can be. The same goes for an economic cliff. If the JobKeeper scheme ends as planned in March next year, the fallout is unlikely to be immediate, and you can expect governments, businesses, and individuals to react. So while it is reasonable to expect that more people will lose their jobs immediately, many job losses will take months and months to eventuate. Many others will hold on to their jobs, but also new jobs will be created. So as for the mortgage deferrals, this will be a staggered process. Only those that successfully negotiated a deferral in March will have their repayments returned to normal in September. The reality is that everyone will have their deferrals end at different times. And as we've reported before, many mortgagees are already making those payments again because they weren't as badly affected by COVID as they thought they were going to be. Consumer confidence is a very, very fickle thing. Fears about the economic cliff could in part become a self-fulfilling prophecy. A hit to confidence could cause the feared decline. On the other hand, given any decline is unlikely to be immediate, that could be looked upon favourably by investors and markets. Now, remember also that our government isn't just a passive observer of the economy. They can take action to prevent worst-case scenarios. And they proved this by the quick introduction and also extension of JobKeeper, the doubling of the JobSeeker payments, the introduction of that pandemic leave in Victoria, and the many, many other stimulus packages introduced since. If it looks like the economy will fall off a cliff in March, then the government won't just let that happen. They will intervene. And in regard to mortgage deferrals, discussions are already underway between the banks and the regulators on how they can continue to support households once their deferral period ends. So, for those sitting on their hands waiting to see what happens, you're going to be waiting a long, long time doing nothing because there's always going to be something happening in relation to this. The fallout from this pandemic is likely to last many, many years, one way or another. Area research is one of the most important things that you need to do when buying property. Click on this link here to listen to some of those key questions that you need to be asking when you're researching an area, and watch one of our area reports right here and right now. Western Sydney is Australia's third largest economy, and its population is expected to grow from 2 to 3 million people over the next 20 years. This Blacktown Council area has emerged in recent years as Sydney's most popular market for home buyers and investors. The upgrades to road and rail infrastructure add to its appeal. The naming of Schofield's Town Centre and Seven Hills as priority growth centres are other major elements that present property buyers with opportunities. There is also significant business expansion in the region, low unemployment rates, and upgrades to Blacktown and Mount Druitt hospitals. The whole area is destined to become an economic powerhouse because of the new airport being constructed at Badgerys Creek. The region surrounding the airport has been nicknamed Aerotropolis. The airport is forecast to take 80 million passengers a year, which is twice the number currently serviced by Mascot. Completion is expected by 2026. Blacktown stands out as an area with a good record on property price growth, which is based on rising sales activity in many of the suburbs over the past 4 to 5 years. Prior to the Sydney property boom, the area grew in popularity around 2009 to 2010, with lower-end buyers targeting it as an affordable area with good transport links. Since 2013, the median prices for many suburbs have grown strongly, with some delivering double-digit annual growth rates. The rate of growth has moderated more recently, but most suburbs now have long-term capital growth rates of 8 or 9% per year. Please subscribe to our channel so that you don't miss out on our area reports, our webinars, and further news updates. Please leave me a comment below. Let us know if you have any questions or any concerns about your property buying. And please check out our website for more details on our services and how our advisors and buyers agents can help you. And I will see you soon. Bye.